Good morning. This is Stanley, and good evening, everybody. And welcome to our webinar number 41. Wow, webinar number 41. And thank you so much for joining me this evening. As usual, we're going to have a fun-filled webinar for you. And today, I have decided that we're going to travel back in time a little bit, back to the basics because if you have not noticed, the market has been doing pretty well over the past close to 2 years now. And even though there has been a lot of drama happening, both in the economic field and also politically, and yet the stock market has been going pretty strong. And the results of that is that I'm getting more and more requests from clients and also from viewers that they are interested to start investing again due to the bull market. But I decided that it's good that we have a chat on some of the key basic things that I have learned over the past few decades on investing and how I got started and what are some of the key mistakes that I've made in the stock market. And hopefully, you will be able to avoid those as well. And thinking back after all these years, if I were to start investing again today, what would I do and how would I plan that process? This is the key rationale for presenting today. And I would like to share that with you. So let's get started. All right. Let me know if you guys can see the slide. Feel free to pull up your chat box and let me know where are you calling in from. I can see Casey is joining us, Chiliong, Dorothy, Japal, and Victoria. Thank you for joining us this evening. And I hope we're going to have a fruitful session today. So along the way, as you have any question or any comments at all on some of the things that I talk about, if you want to add some of your own input, do feel free to put on the chat box and let us know and has a discussion as I go along. And if you have any question at all, I would try to pick that up at the end of the session. All right. Okay, so as usual, before I begin, I just like to highlight I am an employee of iFast Global Market in Malaysia. I'm a wealth advisor for them. But this presentation and this webinar is based on my own work and does not represent their view, the company's view, or any of my colleagues' view in any of these presentation. And also, what I present here is purely for educational purpose only, and do not, please don't take this as investment advice. If you need to speak with me one-on-one to better understand your situation and give you your unique, tailor-made advice, do reach out to me for a one-on-one session. Okay, and this is part of a webinar series that I'm doing. I've been doing it for quite a few years now, I think close to 2 years. And every other Wednesday and every other Wednesday, I will be sharing this webinar. And most of it surrounds ideas around some of the stocks I'm looking at, ETF, I'm looking at some of the funds I'm looking at. But also once in a while, I give market updates and also personal finance or investment finance, investment link educational webinars as well. So if you liked to be on the invite list and not miss out any of the information, do reach out at learnwithstanley.com to get onto my invite list. If you are new to me, I am Stanley, and I'm actually have been sharing a lot about investing over the past decade. And I have co-wrote a book with a dear friend called Value Investing in Asia about 7 to 8 years ago. And from there, I have been sharing it mostly online and mostly through my YouTube channel as well. So if you're new to me, you can check out my profile at learnwithstanley.com. iFast, of course, is a wealth management platform. If it is, we are a listed company in Singapore. Uh, and with the platform, it basically allows you to manage your investment through different asset class, be it unit trusts or bonds or just some cash management and stocks and ETF as well. So if you want to find out more, you can also reach out to me as well. So, um, my key philosophy when it comes to investing, maybe it might be a little bit different from some other people that you might heard of on the internet or are sharing investment information on the internet. But I tend not to invest too much into, say, uh, things that are in a popular genre right now. So I base my whole investing philosophy on these key four things, which is I try to focus much more on very, very long-term macro trends, finding key markets and key industry that I feel will do well for the next 10, 15, 20 years. And then focusing my search around there. And instead of looking for, when we all start investing, we always have this notion that we have to maximize our return, have to find the best return out there. I tend to flip that thinking opposite and think about what are the risks that I should avoid in the stock market. Because in my mind, I feel that as long as we invest in the right market that will do well in the long term and at a good and maybe reasonable valuation, things will do well over uh, a period of time. As time goes by, it will become better and better. And what we should do instead is risk management. How can I avoid making mistake that I cannot reverse and I cannot come back from? Next is trying not to time the market so much and always keeping calm and being more contrarian, meaning that we do our own research. We try not to focus too much on what is everyone chasing after. And in fact, when market is doing so well in the past 1 or 2 years, it actually gave me a lot of sleepless night because whenever market become too good for too long, it attracts more and more people into the stock market. And that means that we get more and more new investors and people who might not fully understand the danger of the stock market. And that could create a bubble over time in the stock market. And when the bubble pops, then there would be a huge decline, which we are almost impossible to time. So instead of trying to time when is the right time to go in the market or when is the time to get out of the market, I see myself as a stocks and fund collector. And as long as I have, access funds that I can invest in for the long term, I tend to store them in funds and in stocks. And in that way, I'll go through my process later. That is how I plan out using the stock market to build my wealth for the long term. And I named my whole process as what I call the everlasting portfolio. So it's a strategy that, be it that we start from just a few $1,000 or we start with a few $1,000,000, the strategy should be able to stand the test of time, and it should be able to scale as our capital increase. So that's basically what I'm trying to do, and helping my clients achieve that as well. And over the past 17, 18 years, I have been tracking my own portfolio and how it is doing. And so far, I would say that it is doing pretty okay. But you will see that it is never a smooth ride. And almost every 3 or 4 years, you can see that my portfolio tend to decline. The worst one I have experienced might be a decline of maybe 30, 40% so far. So that is something to think about in investing, that is never going to be a smooth ride up. So if you are interested to have a one-on-one discussion with me, you can always reach out to me either through this QR code you can scan, and you can reach out to me through the Google form, or you can also find my email from learnwithstanley.com, and you can I hope to have a discussion with you one-on-one. So today we're gonna talk about how to get started in the stock market, how to get started in investing. And I think this webinar is long overdue. And I wanted to touch on not just the practical side of investing, on how to get started, but also moving a step even back to start from finding your why, your motivation to start investing, understanding what the market can do and what the market cannot do, and what we should think about before we even start our own investment account, and how then we can put them all together in a practical manner. So I feel that whenever we rush into investing without truly understanding our why or what we are hoping to achieve from the stock market, I have seen so many investors come and go without having the chance to at least see the impact of the stock market if they just stay long enough. So along the way, I'm going to touch on hypothetically, let's look at two-person. So this might be, yourself, or this might be people that you know. I'm sure you know of them. We have two-person. One is Penny and one is Peter. And Penny is a very conservative person, and they both of them have saved up, say, $20,000 today, and have decided that they have to start thinking about how to grow this 20,000. And Peter, like the fun-loving character he is, he likes to take some risks, and he's ready to dump everything into the stock market and try his luck along the way. Penny, on the other hand, would want something that is more secure, more safer. She cannot handle the volatility of her money, and she don't like the feeling of losing any bit of her investment. So she was gonna find something very, very safe. And so let's take a look through this journey, how both of their portfolio could do over a 10-year period. Okay, but now going back to you, I'm sure you are interested to think about your investment. That's why you're online now with me. But I would like you to think a little bit about why. What are you seeking? That hoping that the stock market can do for you. If you are open to sharing that, I hope you can share that with me. I will tell you a little bit about my story of how I stumbled into the stock market. Basically, I started investing when I first graduated and started to go into the job market. At the time, I was already learning about the stock market. I was reading some of the books about investing during my uni days to understand, but I never really put any money, right? And when I first started working, when I came back from my uni, and I came back to work, and the first job that I found, I couldn't find any job for almost 4 or 5 months. And when the first job I found, the salary that they gave me was 1,008 ringgit per month, before cutting my EPF and SOCSO. So of course that is not very sustainable for me. And luckily, I have some startup capital from my parents. I'm very grateful for that. That they give me a sum of money to get started in life. And basically, from that urge that I feel that it's almost impossible for me to sustain my lifestyle or whatever using the salary that I have. And one day when I was photostating something, office document, I realized that the accountant of my company has forgotten a payslip where she was photocopying. And the payslip was a manager of mine. I happened to saw it because I wanted to see what the paper was. And it was the payslip of a manager who has been with the company for 30 years. And when I look at the amount that he is having after 30 years of service in the company, I realized that this is not a company that I can stay for much longer. And the prospect is very, very dim for that company. And so, with all that motivation and with the small sum of money that my parents gave me, I decided that I need to do something with that to earn more money. And that's how I basically start investing. Of course, that evolve over time. So your why can evolve over time. The first when I first started is just I'm trying to earn some extra money with that. And through many trials and turbulence and what, and of course now having a family and everything, over time, I would say that now and over maybe the past decade that I have cement a clear why on why I'm investing is that I hope that I can earn enough from the stock market and create enough wealth from the stock market that I can buy back my own time. So to me, I feel time is the most important, and the right to choose what I want to do with my time is very, very precious to me. So, especially a pet peeve of mine is I cannot stand when someone is wasting my time. Even though I might not be doing anything, I rather waste it on my own term, and I don't want someone else to waste it for me. And so, I was hoping that I can reach a point where I have control of my time, meaning that I can choose a career that I want to do, that has time flexibility, and I can see my kids grow up. Um, and now, hopefully, of course, I found such a path with iFast, but being able to do it after creating my portfolio and sticking with it for the past 17, 18, 19 years now has brought me closer to this dream. And that has been a key motivator for me to keep going. So there's a little bit story I want to share with you. And I hope that you can think a little bit deeper as well on your side. What is it that you hope, whatever wealth that you created from the stock market or from investing, what is the thing that you are trying to solve? What is the thing that you are trying to create? What is the ideal life that you hope will happen if you have this wealth from the stock market? If you're open to it, I hope you share your vision with us on the chat box. But if not, I hope you at least write it down on a piece of paper so you remind yourself. Okay? And next is we have to face reality. It's great that you write down your dream, your financial dream, and then we have to face reality as well. I hope it could be. I hope to travel around the world in 365 days. I never have to be at the same place at once. But if you are married with kids and have some commitment, maybe that is not very, very doable, even if you have all the money in the world, right? And the key is for us to be candid with ourselves, be honest with ourselves. What is the reality right now, and what is the my dream? I don't want you to deviate your dream too much, but how can we consolidate and merge the two to create something that is doable, right? Your dream cannot be something that is so far fetched that even you don't believe in it, right? This is a time where when you work out your reality and your dream to find a balance of what is truly possible and what is truly possible if you start investing and you get an extra 200,000 profit from the stock market over time. How would that change it? If you have a half a million profit from the stock market, how would that change it? Do the exercise again, 1 million, 2 million, 3 million, how would that change and shift the vision that you have for you and your family and for your children, for your parents or whoever it depends on you. Um, and that I think would be much more powerful once you realize the tangible difference and uh, the achievability of what you hope to achieve when you start investing, right? And one thing for us to understand is also a key thing that we have to always remind ourselves is that not investing is a luxury. Why do I say that? Because who actually doesn't need to invest at all? The only person who doesn't need to invest at all are people who has more than enough money and doesn't really need extra money. If you have all the money in the world, yeah, if you just put it in the bank with a zero interest and you still have enough money, then there could be, you are in a situation where you don't really need to invest at all. So that's why I said that not investing is actually a luxury. Um, but for most of us, we have to take investing quite seriously because if we don't, our money is actually decaying every single day. Say going back to your own example, right? If you can remember, say a property in 1990s, say a simple uh, a terrace house in 1990, or maybe slightly larger, the corner lot or a semi-D, depends on the place that you are. In Johor, I think in 1990, a semi-detached house could be around 200,000, 280,000, 300,000. But today, if you find a semi-detached home anywhere in Johor area, uh, it could be at least 1.5 in the region of 1.5 million, right? And for other places like Klang Valley or Penang, they could be even more if you're from Singapore. I know, you know the numbers better than me. The point is, if we don't invest and our money doesn't grow and it just sits in the bank, uh, we are actually losing money every single day. And the invisible thief that is stealing the money away from us is inflation. Nobody can run away from it. It's the lesser of two evil that we in an economy that is doing pretty okay. We do want some inflation. In the last few years, especially since COVID, we have seen quite strong inflation in most countries, uh, and that is sadly the case. But the other side of the coin is actually deflation, where things become cheaper and cheaper and cheaper, and it sounds great in theory, but when it happens, it's very very bad for the economy. It means that the economy is going to a very very terrible place. So we do want some inflation, but inflation also steals our cash balance and our money and our wealth away over time. So that's one thing that I wanted to highlight to you guys. Another thing that I wanted to highlight to you guys is understanding the magic of compounding. Compounding meaning how our money can actually snowball and grow uh, over time. The reason that, say, the most famous investor, Warren Buffett, the key reason is why he's the most famous investor of all time is not because he has some magic strategy that nobody can copy and nobody else knows. In fact, his strategy is pretty simple, very straightforward and pretty simple. The only reason that he is the most famous and by far the richest is that he has been doing it the longest, more than most people that is alive today. And his return definitely is one of the best, but it is not considered the pinnacle of the best investor in the world. But the fact that he has been doing it for more than 80 years, now he's 90 plus years, and he has been doing it since age 11. So the fact that he has been investing for more than 80 years is the key reason why he is a billionaire many times over. And the power of compounding works like this. If you just have 10 cents today, and if you are able to double that 10 cents every single week, just every single week, by the end of the year, your money actually becomes $450 trillion. I have to do this calculation a few times because I am also not sure that did I get it correct. But it turns out it's correct. It turns out it's correct that if you are able to double your money every single week for 52 weeks, just on the 10 cents, by the end of the year, that goes up to $450 trillion. And this is a very typical compounding chart. You can see that actually for the first 10, 20, 30 times, the amount is still very, very small. It's still maybe about $100 here in the middle, and then before it shot up exponentially. And this is the magic of compounding. Even if later at the end, I'll show you my own investing track record. I personally didn't feel the impact of that compounding only until maybe a few years ago, like maybe investing for about 15 years, consistently investing for 15 years before I start to really see that, hey, my investing could have some impact for me. So it's a long game, and that is why not many people has the stamina to stay around to truly see the impact of compounding. So that's one, and these are some of the key ideas that I wanted to highlight to you before you even start investing. And one of the very, very important thing is that actually investing is not even step one. If you have decided that yes, you are thinking that you wanted to do something about your money to grow your money faster instead of just keeping them into an interest account in the bank, or you wanted to find options to grow your money even faster, I applaud you. You're on the right track. But to get started straight away is actually not step one. Step one, I would say it's actually uh, looking at yourself first and getting your house in order and building a foundation. What do I mean by that is a few key things. If you are still working, even if you are retired or what, make sure that you build up a certain amount of emergency fund first, meaning that the cash in hand that you have, it could be in the fixed D, in a money market fund, in an interest account, doesn't matter. But these are money that if you want to spend it today, I can have it today, right now. Emergency fund, it should be able to cover at least 3 to 6 months of your household expenses if you're still working. If you're not working, I would suggest pulling that even longer, maybe 12 months or even more than that. And these are just cash that you keep in hand in case of, as the name suggests, emergency, right? So anything out of the blue happens, you at least have access to some cash to help you weather through the storm. And this is the first part that we should be looking at and not even thinking about investing at all. Next one is looking back at your loans and your credits. Do you have any high interest loan, right? Especially for, I am assuming that you are on a similar life path as me. If you're still working and you have a household to that depends on you, most likely you're gonna have some loans like your car loans, your house loan. If you invest in some property, you have other property loans as well. And you might have some student debt or even some credit card debt, right? Uh, the key is to look through all of that and see if you have some high interest loan, especially your credit card or personal loan that is extremely high, more than 10, 20% interest, it is actually better for you to look into clearing off debt first before you even start investing. Okay. Why do I say that? And because this is at the history data of a 30-year growth of, say, a $10,000 investment. If you invest in it in, say, the US stock market, S&P 500, which is the US stock index, that has been growing at about 10.8% for over the past 10 years. 10.8% per year over the past 10 years. Other things like the global stocks. So if you have a more diversified stock market portfolio, the global portfolio is about a 9% return. If you buy real estate, maybe it's growing about 9%. Emerging market, stock market, your Malaysia, Singapore, China stocks, the most you can get a 8% yearly return over the past 10 years. These are actual returns. So gold is about 6 US bonds and cash, right? And you can see that the rate of return that you can get from investing ranges from, say, maybe 0 all the way to 10 plus percent. If you are able to invest consistently and have a yearly rate of return more than 10%, you're actually doing very, very well, right? So that is roughly the rate of return that you should be looking at. So if you have a credit card debt that is charging you 28% a year, it will actually save you more money by clearing out that debt instead of using whatever cash that you have to invest, instead of and then paying the interest on that debt, because that debt will kill you before your investment grow enough to cover the interest for you. Okay, so this is just an exercise. The three questions that I go through with you is an example of the things that I sit down with my clients to run through with them, to run through scenarios with them, with the help of a software that I use, but also running scenario like if they want to have a kid, what will happen to their cash flow. So these are things that I do with them, but these are things that you can run through yourself as well. If you prefer to do it by yourself, and only by getting all those sorted out, I feel then you are ready to get started in investing. Because to know where we want to go, we first have to know where we are, and that short exercise is actually to let you guys think about what is your starting point, right? It doesn't matter where your starting point is. The point is that you know where you're starting, and then that is a much stronger point than running through life and investing without truly knowing, one, where you are, and two, where you're going. Okay, so now we are ready to learn about the stock market and learn about investing. So what exactly is the stock market? So I'll talk things to the very, very basic. So if this part is something that you already know, I apologize in advance, but I hope that you can also add in your input if you are someone that already knows some of this stuff, because there might be genuine new beginners within us that might not have heard of all these things and might not know any of the terms that we're talking about. If you feel that some of the key things that I have left out and is important for everyone to know, do pull up your chat box and share your knowledge with everyone as well. So, number one, what is the stock market? And the very basic of it is the stock market is a market. And like any market, be it a supermarket or a fresh produce market, it sells a variety of things. In a supermarket, you'll find throughout the aisle, you can find good food, you can find junk food, you can find fresh food, cheap food, expensive food, whatever you want, it will be there. Why do I point that out? Is because a stock market is also a market, meaning that we should not assume that just because a stock or a company is listed, wow, this company must be a good company, right? What a very key thing is always that uh, we got excited into stock market might be because a friend was telling us, wow, he met so and so who is the owner of a listed company, or you met someone who is a listed company shareholder or CEO of the listed company, and your first thought is, wow, I know this person, I should buy the stock. But logically speaking, it doesn't make sense at all because we can know anyone. That doesn't make the company, the thing that we want to buy to be a good thing that we should have. Meaning that any kind of company, although there are some prerequisite for them to get listed, but in theory, it's still a market, meaning that you will be able to find any kind of stock or company within this market. There will be good companies, there will be junk companies, there will be new and fresh companies, there will be cheap companies, and there will be expensive companies. And it is not our job to buy everything that we see. Okay. And the stock market, typically, every country will have one or two, sometimes three stock market. And the biggest of them all, of course, is the US market, the two key stock market, New York and NASDAQ. The other, some of the larger ones around the world are your Shanghai Stock Exchange, Japan, India, Euronext, um, Hong Kong, Shenzhen, the rest of Canada and Saudi Arabia, which is not common for us, right? So these are some of the key markets that that is out there, um, and also bear in mind, these are all stock market where companies can list onto the platform, and it doesn't necessarily mean that the company must be a local company for them to be listed on that stock exchange. So a New York Stock Exchange, companies from around the world can be listed on this exchange. Similarly, on our Bursa, on Singapore SGX, companies around the world, they can choose to list anywhere that they want. Uh, so not only for the local companies. Okay, and what can we find typically in the stock market, right? What are the choices out there? There are two key uh, asset classes, I would say, from the stock market that we can access. One is called exchange traded funds. So these are for short ETF. They are basically funds. They are basically very, very similar to unit trusts, meaning that they are just a collective of funds, a collective of capital. Say a group of people pool their money together, and then once they pull together, then it becomes a fund. And that fund can go to invest other things like stocks or bonds or even into other funds or buying real estate and things like that. So as a collective, they're just called funds. And exchange traded funds are funds that is listed on the stock exchange. So there's no distributor or agent needing to sell that to you. You can buy that off the stock market by yourself. And these are exchange traded funds. Typically, funds would still have some fees associated with it, and they will need to be managed by somebody, by fund managers, and they will have a management fee. So ETF right now, they are considered one of the lowest cost funds in the market compared to your unit trust or mutual funds or other funds out there. But they still have some management fee, and it could range from 0.03% to 2% of asset. What does that mean? It means that every year the fund will charge a 0.03% to 2% of the entire asset inside the fund. They will claim it as their salary. So that's basically it. You don't really need to put in more money to pay them, right? They won't give you an invoice and then you have to make payment extra, but they will just take it out from whatever that you have invested. Say, for example, if you invested $10,000, and if that fund has a 1% fee, meaning that every single year, $100, $10,000, $100 will be deducted from that capital that you have to be the salary for the fund managers. Okay, so that's number one. Number two is a stock. A stock is basically ownership of a company, a part ownership of a company, or a part ownership of a group of asset. If you're buying into, say, REITs or business trusts, so these buys you a part ownership into something, and typically is a company. So, for example, let me run to in front first. For example, you can buy the stock of Apple on the stock market. And when you buy into it, be it just one share or be it buy a million shares, you become a shareholder of Apple. And that means that if you want to go and attend the general meeting of Apple, you're allowed to go in, you're allowed to ask questions to Tim Cook, you're allowed to make suggestion to the company during the meeting. You are a shareholder. They have to hear you, and you have the right to vote. That means that is what it means to be a shareholder, and that's what it means to buy a stock. Okay, so for ETF, just running back again, for ETF, the most famous one that you might have heard of is this ETF called Vanguard S&P 500 ETF, and the ticker in the short form is VOO. And this is the largest ETF, one of the largest ETF in the world, about 600 billion in size. And so when you invest into this, when you buy this, basically they take the money and buy the top 500 companies in the S&P 500 index, which is the US market. They'll take the money and then buy the US stock market. And there are many, many types of ETF. We're going to go through with them maybe later. I'll show you a way that you can screen it out. But most of the time, they are split out through either different markets or different industry. So you can find all the different types of ETF that you want in the world. Yeah. Before we go into the practical things, one of the last concept that I wanted to share with you guys, which I feel is a very important concept, is highlighted in this book, which is one of the first investment book that I've read by Benjamin Graham, the mentor of Warren Buffett. And in it, he highlighted a key concept called Mr. Market, right? Mr. Market. And what he's trying to say is that we should imagine that when we're buying and selling in the stock market, we're actually buying and selling from one particular person. And this person is called Mr. Market. And this Mr. Market is someone that is highly emotional, highly influenceable by other people and by what's happening in the news. He panics sometimes. He get very greedy sometimes. Depends on the mood of him. So, and every single day, every single second, he'll come to you asking you for a price of what you want to buy or sell the stocks that you might be interested in. And so if you're dealing with such a person, when you're investing in the stock market and you're dealing with this Mr. Market who is electric and uh, volatile, how should we behave? Right? How should we behave? We should use him to our advantage, meaning that we should use him when when he's getting panicky and wanted to offload some of the stocks And in a panic mode, that's when we should take advantage of him. And if he becomes too greedy and wanted to buy everything of the world, then we should also take advantage of it, maybe looking at a good time to sell off to him because he's being irrational. So market, Mr. Market, in my experience, for most of the time, he's quite normal. In most period in the stock market, he would be behaving quite normally as per a normal person. But very so often, he will go crazy and he will either panics or he'll become too optimistic about something. And so a big part of investing is actually just waiting and sitting. You'll realize that in investing in the stock market, the more effort that you do, the more action that you do, doesn't necessarily equate to better results. And that is something that we have been taught since young, to achieve something, to to have better result, we have to put in more effort. We have to do more action. And that is what we have been taught. That is something that has been indoctrinated into our mind. But the logic of the stock market is actually kind of opposite. The more we do could actually be detrimental to us. In fact, in the stock market, we should think and approach it like maybe how a sniper might think about something. We have a target, but a big part of the job is actually just sitting and waiting for most of the time. And it's so boring that not many people is able to do it. So once you have all the concept of investing, let's get down to business on the first thing that you need is actually to start a investment account. Let me change the slide. Not sure if my session is still here. Okay. And just going to show you a rundown of, I'm just using iFast as an example. And this would be what a typical trading account will look like. Okay. So our trading account looks like this. When you go to trading, you have access to all the markets. For us is Bursa, Singapore, Hong Kong, US, the different US markets, 1, 2, 3, 4, the China markets, Shanghai and Shenzhen, and the London Stock Exchange. So we have access to all these markets. But how do you read this? So we'll go through it quite simply, and I'll just highlight to you guys how you can think about it. Let me see if I can change some of the more popular stocks. Okay, so let's start with the Malaysia market, right? The way we arrange it is we have code, name, last, change percentage. Okay, what does all this means? Code is basically, another word is ticker, T-I-C-K-E-R, right? And every single stock would have a code, regardless of what markets they are in. And that's the way that electronically they are categorized. So every market has their own system. Malaysia tends to use numbers, right? Typically 4 numbers. So every single company, so this is Mbank, I think. This is Public Bank, Genting. So every single stock, they would have a number to it. Sometimes you have a letter after the numbers. Typically, this would highlight different type of stock, be it their warrants or things or rights. We'll not go into that too deeply. The key things to note is that every single thing that you can buy would have a code and a name. Okay. And last is basically the last price that a deal has been done, because the market is constantly moving and people can buy and sell. And once a transaction is done, then that will be the last price that it has done the transaction in. Change is basically throughout the day how much it has changed in terms of the magnitude and in terms of percentage. When we are investing in the stock, whichever stock, I would say that the actual price of this stock, be it $4, be it 60 cents, 70 cents, it doesn't really have much meaning to it. Doesn't mean that a stock that is $4 is good, a stock that is 70 cents is bad. It doesn't mean that at all. It's just a number as a reference point, right? So that's one thing for you to note. Then you have the change. We have the bid quantity, meaning that how much is people actually bidding, meaning that they wanted to buy. So bid means how many buyers want to buy the stock in terms of the number of shares of stocks that they want to buy. Lah. We can't really see the actual person, how many person is trying to buy, but we can see how much they want to buy. So this is 57,000 shares they wanted to buy. Then this is the bid price, meaning that these buyers is saying that if we can deal at $4.50, I'll buy it. Then the sellers is us, right? Is looking at the ask price. So this is the seller saying that if it goes to $4.55, I will sell. So there's a gap. So nothing is happening, right? When there's a gap, nothing is happening until somebody give in and say, okay lah, I would sell at $4.50, and then somebody will change it, and then that becomes the new price, the last new price. So this is how many sellers is there trying to sell this, and total volume is actually how many deal is done today. So for this stock, about 17 close to 18 million of volume done, right? How many shares have been changed hands? What's the price it has opened, right? In the big right at the in the morning when it starts work. What is the price that it opens? What's the lowest that it has gone today? What's the highest it has gone today? And what's the price that it has closed today? Right at market close, what's the last deal done? So this is basically how you read this. Is for every single stock market is the same except the code. So uh, Singapore tends to have a code that is a combination of numbers and alphabet. Hong Kong is also just mostly using just numbers. Nasdaq would be using all letters, right? All the US market, you can see that they are all using just letters instead. Shanghai also prefer numbers, but the numbers tend to be longer. Shenzhen similarly. And then we have last one for London Stock Exchange using alphabets. Okay, so these are basically how you can look at when you log in to look at how you can see different movement of the stock. And once you have account, most of I would say investment account right now, you should be able to sign up online. But I would highly encourage you to make sure that the whatever you know investment house that you want to use or banks you want to use, make sure they are licensed entity. We all of us know that there are so many financial scams out there, and just be careful, everybody, and always make sure that you can actually check from, say, from the Bank Negara side, from the SE side, if you're Singapore, on the MAS side, to see if a company has been blacklisted, or only who are the authorized and licensed uh, investment fund houses in your country. Okay, we will touch a little bit about ETF, but maybe later. Let's go back to the slide. Maybe doing this is easier. Okay. So we talk a little bit about how to search for stocks later. I'll share you with you an example. How do I actually search for stocks, and also share with you an example. How do we search for ETF? Okay, so these are some of the website that you might be interested in. ETFDB.com is a key resource that I use for ETF, but of course I also use the iFast platform as well, or ETF.com. And let's go back to this one. Okay, so let's start with what should we do? Should we do stocks first? Let's do stocks first, right? Okay, stocks screener. So stock screener is basically a software that allows you to search and narrow down your search for a stock, because most of the time, um, in every single stock market, there would be quite a number of stocks to look at. In Malaysia, close to 1,000, Singapore, so 700, 800. If you're talking about the US market, 10,000 stocks. So there's so many companies out there, and it's a market. Again, it's a market, and we should not just jump just because something is a listed company, then it means it's good and we should buy. No, no, no. There's still a range of quality in the stock market, and it is our job to make sure that we buy the right stuff. Okay, so just do a simple one. What are some of the key things that I tend to look at? Debt, right? I tend to look at debt. I tend to look at, say, their revenue growth, their net income growth. Say what is their return on equity or gross margin. I'll share a little bit about what are all these things. Uh, let's not do all. Let's do Singapore, Malaysia, Hong Kong today. And let's go one by one. I like to screen for debt, meaning, okay, so you know that debt are just loans that the company uses, and equity is the capital that the company has come up with the capital that the company has come up with itself, which is from its shareholder, from us. So we as shareholder get rewarded uh, because we have invested in the equity of the company. So the debt over equity tells us how much debt the company has to its equity. And we want that to be as small as possible, not too crazy. Okay. Say I like to be conservative. I don't want the company to have too high of a debt, say more than one time. So the debt should not be more than the equity. Okay, for example. Then I want a company that is growing. I want a company that say should be at least growing. Let's not go too crazy, right? Let's say I want it to grow at least 5% a year, annualized growth, right? I want 5% a year, but I also don't want it to grow crazily, because that will means that the company account is uh, is not very reliable. It's going a bit haywire. If some, for a company account that can grow 200,000% for 5 years, logically it doesn't make that much sense. So let's stick to something more realistic. Say 50. The same for the income. I don't want in the same range, right? The net income, the profit should be growing around the same range. I like to screen for gross margin. Again, if anything that is confusing you, or if you have any question, feel free to just put up your question on the chat. I love to clarify with you. And anything that you find that you need more explanation, you can also let me know. So no worries, okay? So gross margin, what is gross margin? Gross margin is basically the uh, the profit that it has on the particular product or services that it's selling. Say, for example, this company is selling a phone, right? If it's selling a phone, if it's selling it at $100, just for example, if it's selling at $100 and it costs $50 for them to make, that means that the gross margin is 50%. They make $50 from the selling price of 100 from this product that they make. So their gross margin is 50%. Okay, it will never go more than 100% because we are dividing over the revenue, which is the selling price. So 50 is actually very, very, very good. Uh, so let's say we want a company that has the maximum of gross margin about 80, and then we don't want a company that is selling things that is not earning much money. So at least a profit margin of say 25%, right? Um, Return on equity maybe is something that we don't need to touch on today. That's good enough. Okay, so these are the things that we put out. Let's screen for it. Let's screen for it. And these are the companies that come out from the software. We can download it into Excel. We found 100 stocks. Okay, and this will be the starting point. So when I invest, this is basically a process that I go through. I'll screen for the criteria that I mentioned, the market that I want to look at, and now I have 100 stock to look at. And I tend to start from the biggest one. So I will do it in terms of market cap, and I'll start from the larger ones. Yeah. Um, to see because I tend to prefer larger companies. This is just a personal preference, and you can have other preference like you want something with higher dividends, you want something that is maybe having a lower valuation, whichever it is. But this is a great starting point. And then from there, we can click in and see, learn about this company, China Mobile. How's China Mobile doing? Look at the financials of China Mobile, the valuation of China Mobile, and all that jazz. Okay. If you want to go one step, you can definitely, if you want to be, if you're thinking of investing in stocks yourself, I would really encourage you to start reading the annual reports of all these companies. The more you read, the more you get the gist of their business and how businesses are run. Then the more experience you become, you'll be able to find out if the company is good or not good, or company is bullshitting you with without too much work. So in the beginning, say for example, when I was first starting out, I could be reading annual reports up to 10 years of a company to truly understand the business and truly have a view on the company. It could take me, up to a month to have an opinion of a company. But as I do it more and more and more and more for over the past 10, 20 years now, typically when I screen through and look through the financials of the company, more or less within 10, 15 minutes, I know if this is a company worth my time or not, more or less. Right. So it comes with experience, then you'll be able to do it much faster over time. But if you want to be a DIY investor, I would say that might be a path that you would need to go through to learn the craft, right? Another way that of course I'm a big advocate for is just buying ETF. And ETF, like I said, they are just funds, and we can uh, just invest in areas that we liked, right? Say, for example, if I like the US market, I would just buy the US market. And within iFast, we constantly have ETF ideas and what we call a focus list, which are some of the ETF that we like ourselves for the company research team has highlighted. So I think those are a great starting point as well. If say, for example, something like this, a semicon ETF, that if you want to buy into the semicon industry or Europe or or the S&P 500. So everything here, even for bonds as well. And these are great starting point for us to look into. Okay, so I will encourage you to take it slow and feel your way around. But what I have seen that works for most people, and something that I encourage you to look into, a key strategy, is what we call dollar cost averaging. What does it mean? So dollar cost averaging is basically meaning that we have a schedule of investing. So we cannot treat it as today I feel like investing. Today my friend told me about a stock that is interesting. I'm gonna buy something today. Tomorrow nobody talks about it, then I forget about it. And then I saw my stock going down. I don't want to cut loss. I just hold it, and then I hold it until it recovers. I break even after 2 years. It break even. I sell it and never touch stock again. So that's a typical path of an investor. But to be more successful in the stock market, we should have a plan. And a simple and effective plan that I've seen that is useful is what we call dollar cost averaging, meaning that we automate our uh, our savings. So it doesn't need to be investing straight away into a particular stock. So within the IFA system, we can set auto debit every month from your bank into, say, maybe our money market fund, for example. And it just goes and sits into like a fixed D kind of instrument. And then that becomes like a forced saving, and that one has completely no cost to our client, and is a great way for people to get started on dollar cost averaging. And this action of saving a certain amount every single month would mean that we will always have new money to invest. And you can see this might be a very complicated chart to look at, but I want you to focus on these two lines below, the blue line and the brown line. The blue line is the total money that we have invested and put into, and the brown line is the value that it becomes over time. So these are real data over the past 10 years, and you can see that as we save more and more, even though the market is going up and down. So the bar is actually what's the market doing lah? The market doing up, going down. But as the market goes up and down, you can see that almost for the first few years, you will not see you don't see a big impact, right? Whatever you save, it grows, maybe not too much, but it's growing. And this action of automated savings means that you're building your wealth anyways, right? So you're building your wealth, you're investing. Nothing much has happened yet, not big in profit, but sometimes there will be an event, and then you'll see, oh, some significant gain. And if you continue that process over time, then the market can go up, go down, market go up, go down, go up, go down. You can see that if you have used this strategy, there's never a time over the past 10 years that your investment would actually drop below your cost. So as you're doing it consistently, more and more and more and more, and averaging up, averaging down, you can see that your value of your investment is always in the positive, regardless of how the market is doing. Even after a big market crash, it's still more than your investment cost. And this is where you see the power of compounding. Because if you just save it, this is where your funds, your saving will become, say, $100,000. But because you're saving and investing in the same, and investing at the same time, and averaging costs in your investment, the last 10 years, your investment would have doubled. And that's how it works. And I have mentioned this before. The output that you want can only be as good as the input, which is why I highlighted that having an automated saving, say what we have from IFAS, the regular saving, into say even a money market fund, is so important that if you have that consistency, then you'll see your wealth starting to build and you're one step closer to the dream that you are wanted to create. And I don't know about you, because for me, at least, if I don't do that, if I don't move my money into my investment account and I just keep it in the bank, something happen. I don't know why, but the cash will always disappear after a while. Even though I have no plans to use it or whatever, if I just put it in the bank that I use every day for my daily expenses and don't move it into my investment account, that cash, I can guarantee you, it will disappear. You try it and let me know what's your case. Okay. Yeah, that's some of the key things that I wanted to highlight to you. And then we can talk about maybe in the future about how to carve your ETF portfolio. What is asset allocation? These are all things that we can talk about in the future. Today I want to keep it more simple to the basic stuff. And going back to our story at the beginning, if you have two-person, one is very, very conservative, Penny, and one is more gung-ho, Peter. And Peter decided to just go into the stock market. And Penny decided that she just want to keep your money into very, very safe investment, say your fixed D, maybe. So you can see how their wealth will grow over over the next 10 years. Say if Penny is able to get an interest rate of 4% from their fixed D consistently over the next 10 years, her 20,000 will become 28,000, but very linearly, almost like clockwork. Peter, on the other hand, would have a better result of 43,000, but you can see the path that he goes will be one that is very, very volatile. And the danger happens here, right at the beginning. Because, yes, Peter comes out better on top over the 10-year period, and he achieves, say, a 8% per year return, and his money has grown more than doubled to 43,000. But many, many people, what happens is when they start investing, their investment drop for the first year. It doesn't, it goes back, but maybe not too much. So two things happen. If they drop, they cannot stand it anymore. They cut loss and they say that the stock market is a scam and they never want to touch it. Or they drop it, but they don't want to sell. They hold on to it. It recovers over the next few years, 3 or 4 years. It recovers and they sell out, saying that the stock market is too volatile for them and they never want to touch it anymore. And they never get to fully enjoy how compounding works because they always give up here. And only after the thunderstorm can you see the rainbow. So the key when you're investing in the stock market is actually not to be the best investor or find the best return. It's just to stay in the game. That's the secret to it. And you can see the longer you stay in it, every bits count. And this comes to, even looking at how you manage your costs. Every few percentage point that you're able to eke out a differential every year over a long period of time, it would be millions of dollars. All right. And I hope you enjoy today's session. If you have any question, I'd love to speak with you. If you want to speak with me one-on-one, you can always reach out to me. either by filling up this Google form right here on this QR code, or go to Learn with Stanley, and you can also access this Google form or find my email as well. So this is my website, Learn with Stanley, and if you go scroll down to free financial health check, click on it. It will bring you to the Google form to fill out your details, and I'll reach out to you. If you're in JB area, feel free to drop by our office. It's in Taman Molek, you know. And if you prefer the one-on-one on a physical basis, you can also let me know. So, thank you so much. I hope you enjoy our session today. If you want to continue to follow some of my updates in the future, you can always follow me from my YouTube, Learn with Stanley, or my LinkedIn or my Facebook. These would be the three places that I tend to update more often. You can just search my name, Stanley Lim. Okay. Last two slides. I always have a spin-off section, I call it. This is something not related at all to anything, but something interesting that I found. This is a podcast I've been listening for years called Founders by David Senra. And this particular one that I think will be interesting to you guys, which is number 388, where he ran through Jeff Bezos' annual shareholder letters. Jeff Bezos, of course, is the founder of Amazon. And in his annual report, he writes a detailed letter to the shareholder about his thinking or how he thinks about his business. And I think this is just a great reading material to understand about business. Is business masterclass from the beginning, from day one, as he said it, how he think about creating Amazon from an e-commerce bookseller all to where it is today. And why I highlight this is because when you're learning about investing, we have to understand that investing is not really about trading or about the stock ticker going up and down. Benjamin Graham said investing is most intelligent when it is most business-like. When we think of the stock that we want to buy as a businessman and analyzing if this is a business worth my time, then we would have a clearer idea on what kind of stocks that we should be investing in or what kind of funds we should be investing in. So it's very important for us to understand how great business leader actually thinks. So this is something that I think would be very useful for all of us. And I'll leave you with a quote, as always. And this one is coming from Leo Tolstoy. If you look for perfection, you will never be satisfied. And similarly, if you look for perfection, you might never even start. And investing is a messy journey. You will not find perfection here. But if you're brave enough to get started, I'm sure you'll find an adventure. All right. Thank you so much for all your time. I really hope you enjoy our session today. Again, NK, Chia, Linus, Casey, Dorothy, Chi Leong. I hope I didn't miss anyone. CK, Renu. I think some of you have already left, but thank you so much for your time. If you need to speak with me, just reach out. If not, as always, till we meet again, invest safely, guys.